Hi, I'm Sarah Burns with the Salt Lake Local. Today, we want to give you a forecast on the 2021 housing market. There's a few things we're going to cover in this podcast. We'll cover the current housing market. We'll cover the effects on the market of the COVID virus. We're going to discuss the strategies which are being utilized right now in order to keep the market feeling secure and whether those strategies can remain sustainable. And we're also going to talk about some really fantastic things about living in Utah. So let's start with what we're seeing in the current housing market. Right now, we're seeing multiple offers, whether we're dealing with the home priced at $350,000 or a home priced at $1 million or $2 million. These homes are receiving multiple offers, often inflated well above list value. The offers are coming with no contingencies for inspections, often no contingencies for finance and appraisal, cash offers that are closing or a lot of cash at least to full cash, closing within 2 to 3 weeks. Okay, so the market has been booming since about May of this year. We had a little slowdown from March into April, and then it just boomed. Okay, so what have the impacts been on the greater economy and the housing market since March of this year? Let's talk about unemployment. Okay, currently unemployment rates as of September 2020, they sit at 8.4%. Okay, now that's down from July numbers of 10.2%, but well above the numbers prior to COVID in February of 4.9%. Okay, so we're closer to that real high rate of unemployment than we are what we like to keep it under, which is under 4.9%. To give you a point of comparison, in the height of the 2007-2009 recession, the unemployment rate was 10%. Now, what does this mean in terms of numbers? Right now, we've got 28 million people on unemployment, but of course, that does not account for everyone who is unemployed. How we define unemployment is by the people who are requesting unemployment, but we also send out surveys to residents and to small businesses. Well, I shouldn't say small businesses, businesses in general. Okay, now sometimes those surveys are not received and other times they are, but they're not responded to. Okay, so we know the numbers are greater than 28 million. The unemployment rate also does not consider contracted workers. So that's workers like Ashley and I, okay, or any business owner. It also does not consider discouraged workers, people who have looked for weeks and weeks, haven't been able to find anything, and they've given up. It does not consider, in addition to all this, whether those who are employed, whether their wages are keeping pace with inflation, whether they're able to provide for their basic necessities, okay? So let's move on to forbearance programs. In October, $4 billion worth of forbearance programs become due unless there's an extension on that, okay? So to give you an idea, numbers, that's 1 in every 10 borrowers. Now, the forbearance programs have been extended through the institutions who issue government-backed loans. Conventional loans have not had to offer the forbearance programs. It doesn't mean that they won't, okay, but they're not considered in these numbers. The interest rate, when you're on a forbearance program, the interest rate still accrues. The entire amount of the forbearance can come due in October. Now, it might be that some banks are going to say, you know what, we're going to spread this out over 12 months, but other banks may call it in entirety due. And the question is, will the individuals on forbearance be able to pay that amount? Okay. In addition to this, if you've been on forbearance, it may make it more difficult to get a loan in the future. The Federal Housing Finance Agency has come out and stated that beginning December 1st, they want to apply a 0.5% fee onto any refinanced Fannie Mae, Freddie Mac loan. and refinance loans. Okay, now the reason for this is to cover the expected $6 billion in projected losses based within the forbearance programs. Let's move on to supply chain. Okay, China has more than doubled its worldwide trade in the world economic ecosystem since 2003. It in fact accounts for 16% of gross domestic product. Okay, so the supply chain issues we've had have caused some inflation in a lot of different segments of the industry. Where in the housing industry is concerned, we've seen an increase of up to 80% in lumber prices. Now, those prices are passed on to the end user, that's you and me. The amount for single family, if it's new construction, is $14,144. If it's multifamily, the amount passed on is $5,322. The National Home Builders Association has come out and said that this kind of inflation happening so quickly, virtually overnight, that it's not sustainable and that it will impact the market. Let's talk about small business loans. One thing you hear with small business loans in this pandemic is, local businesses, they don't have to worry because they have access to the small business loans and they are forgivable. But the small business loans are only forgivable for 2 months, okay? Unless they expand this policy, they're forgivable for 2 months worth of the loan. In addition to that, in order to be eligible for forgiveness, 75% of the funds have to be spent upon payroll. The other 25% must be spent on rent, utilities, and interest payments. Okay, so this has left a lot of, especially small business owners, with inability to meet their overhead. In addition, in order to be eligible, your numbers of employees and the wages have to be equivalent to the same time that you're getting the loan from 2019. Okay, so that's impacted the choice of so many small business owners to want to get these loans because they don't know that they'll be forgivable in the first place. We do know that capital expenditure rates are down. These are the loans that businesses get in order to support their growth. Okay, so big impact in the commercial market as well. So with everything that's going on, why do we have such a booming housing market right now? Why do things seem so solid? In election years, things are always pretty good, okay? And there's a lot of strategies. And one of the strategies for a very long time to keep us solid has been that interest rates have been very, very low. But how have we done this? How have we kept interest rates so low? Because at one time we had interest rates as high as 18%. Prior to the 2000 recession, interest rates were, they were 6 and in the 7%. Okay, so, we really, turning off my phone here, we really have had very low interest rates since the 2007-2009 recession. On average, they've been below 4%, with many people at 2 and 3%. How have we done this? Okay, the Fed recently has come out and said, hey, we're going to keep the federal funds rate really low. We're going to keep it at almost 0% to 0%. The federal funds rate shouldn't be confused with the mortgage interest rates, though often mortgage interest rates will follow it. The federal funds rate is the amount that depository institutions lend money to one another overnight on an uncollateralized basis. The Federal Reserve also mandates the reserve amounts in banks. Okay, the reserve amounts are like insurance for your money, for my money. If the reserve rate is kept high, we have less money circulating in the economy. If the reserve rate is low as right now, we've got a lot of institutions that are at 3%, which is very low. Okay, then we have a lot of money circulating in the economy, but we have less insurance backing for that money. Okay, now there's 2 ways that we can inject money into economy. One way is to give it to the private sector. This occurs with corporate subsidies and bailouts. The other way that we can inject money into economy is into the public sector, into government job creation, into subsidies for housing, education, infrastructure, health. Now, what this is referred to as quantum easing. And what are the effects of quantum easing? Well, one of the positive effects is that, again, very often the mortgage interest rates, personal loans, car loans, they will follow the federal fund rate. So your interest rates will be lower. Okay, but on the flip side, there's also a negative to this. In order to not have inflation when you're injecting money into economy, there has to be a balance between labor and production and the creation of currency. That's what keeps things equalized. Now, the Fed has acknowledged that there's going to be inflation over the next 5 years. So does this mean that a lot of the money is going to be inserted into the private sector? We'll see. That's a whole nother podcast in and of itself. Let's talk further about the possible outcomes in our economy. What can we expect in the housing market? As I see it, there's two different outcomes. Ashley will probably have some additional thoughts for you. We could have, as a result of the forbearance programs and as a result of difficulty in the commercial sector, we could have a lot of inventory come on the market. Okay, now if a lot of inventory came on the market, then prices come down. This is what happened during the 2007 to 2009 recession. Tons of inventory, more than we could absorb, more than what was sustainable in pricing for borrowers. Okay, so that inventory brought prices down, and that left opportunity for investment for first-time homeowners and for lots of people. Okay, that's one thing that could happen. But the other thing that could happen is just a generalized inflation, because we have been deficient, substantially deficient on housing stock since the last recession. In order to bring our prices down, we would have to have a mass number of homes come on the market. We'd also have to have interest rates rise substantially. And it doesn't look like that's going to happen based upon the federal fund rate. Okay, so if that occurs, we could have a general inflationary effect where the cost of living becomes more burdensome to the poor and the middle class, and it would leave a lot of investment opportunity with what does come on the market for high income earners, people with a lot of reserves for Wall Street. Let's talk about things that make Utah very sustainable. This really is a solid place to live in the short term and the long term. Okay, one of the reasons for that is we have very, very low corporate tax rates here. Whether, again, that's a good or bad thing, that's another podcast. But what it's resulted in is it's resulted in a very high level of corporate relocation from all over the globe and in migration. Our corporate tax rates are fifth in the nation. We sit at 4.9%. Okay, so as of 2018, the state of Utah came out and said, expect population growth to double within the next 20 years. And we are well on track for that. It's one thing that's kept our housing prices on the higher end of things. We also have a higher than average median wage. Now, to be clear, the median wage is the point in which 50% of the population is making at or over this number, and 50% is making below. And the 50% making below may be making well below. Okay, but our median wage here is approximately $71,400 in comparison to the national median, which is $61,900 approximately. Okay, so this gives us a lot of buying power in Utah. We also are a recreational state that's close to an urban center. Our urban center has become diverse. It is beautiful. It's eclectic. Theater, ballet, symphony, local restaurants. It's just a wonderful place to live. And there are very few places where you can have access to this kind of urban center, but on any morning of the week, you can walk out your front door and within 15 to 25 minutes, you can be on a hiking trail or you can be skiing. Okay, so this is something that has made Utah very appealing to outsiders as well as businesses. We've talked about housing inventory, how low housing inventory is here, and that has really given a bump to home prices. We have a lot of buildable space in Utah, no matter what county you name, all counties have plenty of room to build. So these are things that make Utah a very solid place to live. We have been noted as in Forbes for the last 10 years within the top 10 states for business. So let's talk about the benefits of recession, okay? And I know you're thinking to yourself, what are you talking about? What kind of mumbo jumbo are you stating in this podcast? In my business, the word recession is like the word Voldemort in Harry Potter. Okay, but what we need to understand is that recession is just a different market which provides opportunity. Without recessions, the price of housing would become so inflated that the majority of people, your children, your grandchildren, the people you love, would never be able to own a home. Home ownership is deeply important. It shouldn't be just considered an investment. It is a survival necessity in this day and age. It is the place wherein we build equity to send our children to college, to pay for our retirement, to give us a basic sense of security. And it is a place of memory and creation. Okay, so home ownership is very important. Without recessions, more and more people would be unable to own homes. Okay, but what you're thinking about in all likelihood is that you've spent years really taking care of your home, making it a beautiful spot, and you have built all kinds of equity in this home, which you're relying upon for many reasons. You're wondering what's going to happen to your equity. Okay, well, the dollar, referred to as the greenback, we are the reserve dollar, and that has made us very stable in economy in the long run, though we have our ups and downs. Okay, now, so long as we remain the reserve dollar and we have a mortgage-backed security system that's operating largely up on that, your values, when we recover from recession, historically, they have always gone above pre-recession values. Okay, so it's a matter of being in your home long enough. We hope this information has been helpful. If you are thinking about purchasing or selling this year or in 2021, we hope you'll give us a call. Whether that is good for you or not depends upon many factors, but mostly it depends upon what your personal and your financial goals are. And we'd love to have that conversation with you. Thank you so much for joining us and look forward to speaking with you again soon.